Embezzlement Ethics Case Studies from the Trenches is being presented by Allison McLeod, LLM, CPA, APLLCC, professor of the University of North Texas. And Allison will examine recent events involving the circumstances that allowed fraud and embezzlement to occur. Case studies we will examine include the SEC indictments of the Buca Di Beppo officers, the 2012 $54 million embezzlement from the City of Dixon by Rita Crundwell, the Baptist Foundation of Arizona, WorldCom, Collin Street Bakery, and the Ohio American Cancer Society, amongst others. At the conclusion of the session, we will move to a short 10-minute break before our closing event.
Okay, well, thank you so much, Peter, for that that introduction. As now seeing that we're in kind of this virtual world that we are, I'm going to be going ahead and getting my screen up here. And let me go ahead and put the slideshow on current slide. Okay, Patty or Keisha, can you see my slides pretty well? I'm assuming that you all can see me okay. All right.
We can. Allison, can you go into presentation mode?
Yeah, I am. Unfortunately, for whatever reason, the presentation mode takes just a moment, so it's going to be loading. I've got it there. But while we're waiting for, welcome, as I said, to the virtual world. While we're waiting for that to load, which will take just a moment, I'll go ahead and introduce myself a little bit. I know that many of the personnel for the National Restaurant Association is in Dallas, and that's where actually I am speaking from, is the Dallas-Fort Worth area. And so that has a couple implications. One, the pollen that's here at the DFW area is the size of Volkswagen bugs, so please do excuse me if you hear a little wheezing and hacking going on. And secondly, there's many of you who are registered from the Dallas area, and they may or may not have heard me speak before, since I speak for Texas CPA ethics quite a lot. But for those of you who don't know me or from other places, my name is Allison McLeod. And in case you're worried that I'm going to be one of those, ivory tower, pie in the sky type of academians, I want to assure you that I started my quote unquote real life as a quote unquote real person, where I had been in industry for over almost 20 years. And right out of law school, I went to one of the big four firms in the Dallas area. And then I worked for a major retailer for 13 years. And at the time I worked for them, they had this huge tax department and had like 60 people in it. And they were a Fortune 50 company at one point. And then after that, I went to an international cement company for a big promotion as director of tax planning and IRS audits and international tax planning. Unfortunately, I went to that industry in 2007, which of course was probably the worst period in the planet to ever work for a cement industry company. And so, but thankfully, even though I made it through there for 3 years until they had so many losses, they had to do a bunch of layoffs. But then from there, I went to the UNT, and I've been there for, gosh, almost 11 years. And so the reason I tell you all this is because, I've been in the trenches where you are, and it's very, very real. And the ethical issues that come your way, it's not theoretical, and it's not ivory tower. I mean, whatever you decide on a last minute basis could have huge implications to those around you. And so, I'm going to approach this from the standpoint of, yes, we're going to see some fraud cases and see where, gosh, people did really, really wrong things. But on the other hand, what it should also warn you, kind of be as a cautionary tale, that it could happen to you. It could happen to any of us, and so that is kind of one point that I'm going to be making as we go through this. Okay, so let's go ahead and talk about why the fraud can occur, okay? And some of it is because, for instance, there's an inherent higher level of trust. And what do I mean by that? Well, the company I worked for, the retailer, it was an old was considered one of the old-fashioned companies, and it's one of those companies where everybody starts there and they work there till they die, you know, and the average tenure in the tax department when I showed up was like 22 years. Okay, so everybody loved working for this company, and a lot of times you have an inherent higher level of trust because everybody knows each other, you know, and even in the restaurant industry, even if there is movement, it seems like everybody sort of knows each other in the industry in a certain field, especially something as specialized as finance and tax. You know, it really is kind of a small world. And, you know, when there's job openings, it's sometimes you kind of see a lot of the same people because of your specialization and your industry. And so a lot of times it does start to have this feeling of being a village, and everybody knows each other. You know each other for years. You've worked with each other, and you know, you just assume that they've got your back and you've got their back, and you assume that everybody's well-meaning, which most people are, but and unfortunately, it makes you kind of put your guard down just a little bit. Sometimes, if you're especially in these days and times when everyone's kind of strapped, you know, we're trying to recover as an economy, you may have limited resources and expertise. I mean, in the accounting systems, you know, you want to have separation of duties. Well, maybe you don't have very many personnel to separate the duties to, and so that can be a problem. Some of it is just internal controls are completely ignored, or they don't have internal controls. And you know, there are you know, some of the unfortunate things as I teach accounting to my students here at the university. I tell them, you know, one of the things that I find is a real shame is you've got all these, say, smaller businesses or smaller chains, and the owners have put their heart, soul, and blood and sweat and tears into the organization, and they're terrific at what they do, but they're just not terrific at accounting. And unfortunately, because of poor internal controls, there's fraud, or maybe there's not even keeping track of the revenues and expenses. The entity suffers and goes down, and you know, all that work has gone to naught. Some of it is trusted insiders. We're going to see when we talk about Buca Di Beppo, it's one of the trusted insiders was actually one of the founders. I mean, you know, and so just because they've been around, or maybe they even started it, you know, it doesn't mean that we need to let go of our professional skepticism. And then finally, some of it is occupational fraud. They're in the position, and it's very easy for them to manipulate the systems and get what they want. Okay, so just to make sure everybody's, you know, following along here, we are going to have polling question number 1, and Patty's going to be so good as to launch those for me. So you all probably know the drill, but you need to make sure that you answer most of these polling questions. We're not great. Let's see, just so that you know, we can track your attendance.
So Allison, we've
Yep.
got a little bit of a technical difficulty with the polls.
Okay.
So I need to kind of jump on the back end and figure that out. So
Okay, that's
can you
no
move
problem.
on beyond this one?
Yeah, that's okay. What we'll go ahead and do, folks, let's see. I think I'll tell you what, just as a backup, okay, because we want to make sure that NASBA is completely satisfied. While she's trying to figure out the polls on the back end, I'm going to go ahead and go through them. And if you all have like a scratched piece of paper, yes, very old fashioned, very 1980s, but get your scratch piece of paper out, label it 1 through 8, and then just go ahead and write down what your answer is. We'll go ahead and pick it up later if we need to, even through the chat function. Okay, so that'll be our backup plan, but I'm sure Patty will get it sorted. So as she's getting it done, looking through the technical issues, I'm going to go ahead and go through these questions. So which of the following is not a factor which will make it easier for fraud to occur? A food shelter is mission driven and assumes everybody else is too. B, a municipality has limited resources and expertise. C, a privately owned business who is lax in monitoring which employees have access to company assets and accounting systems. Or D, external auditors who thoroughly test internal controls and ascertain whether they are being used. Okay, so and now I know you all are fairly sharp, so I'm sure all of you have lit on answer D, which is that if you have an external auditor who does do a good job of testing the internal controls, making sure they're in compliance with the standards of Sarbanes-Oxley, then obviously that's not going to lead to any problems. Oh, hey, heavens! Look at this. We've got our poll question up. Okay, so I'll tell you what. We'll now do it electronically. If you can go ahead and answer this poll question while it's up there, and then we will continue. You go ahead. I'm going to go ahead and keep talking. Go ahead and answer that question, and then we will continue on. Okay, so what we're going to be doing, we're going to talk a little bit about the AICPA Code of Professional Conduct. And that, of course, is in the AICPA Code, as you can imagine. And all CPAs are governed by it, irrespective of whether or not you pay dues to the AICPA. And it's because they are a national standard setting body. And so, on occasion, I act as an expert witness on accounting malpractice cases. And one thing that I do when a lawyer calls me and says, oh, I've got this situation and this is what the accountant did and one of the first things I'm going to do is look at the AICPA Code of Professional Conduct. And if the CPA has done what they are supposed to per the code, then then it's highly unlikely that they'll ever be found liable, okay? Because if they follow the code, then they will be showing what's called due care. And so, typically either a contract claim or a negligence claim just falls flat, because if the CPA has done what they're supposed to do, then, I mean, what's their defined, right? And so those are the things we're looking at. Now, here is I guess a quote from the AICPA Code of Professional Conduct, and the code has a lot of what we call very specific rules. Do this, don't do this, and then they also have what I call aspirational language, and I think both are good because if you have too specific rules, you're too focused. Oh, am I meeting the rule if I'm not? But if you pair it with not, I need to at least meet the rules, the specific rules, but let's also take a 30,000 foot level look at this and say, hey, is what I'm doing actually supporting the underlying policy that the rule is meant to promulgate? Okay, so like, for instance, I may meet the rule, but am I also maintaining objectivity and integrity, making sure that I'm free of conflicts of interest? And am I making sure that I am not knowingly misrepresenting facts or subordinating my judgment to others? Okay, and so it's good to kind of take the view of both, so that you can have a clear idea of is what I'm doing makes sense. Okay, this particular rule that I have here, it really is kind of the bedrock of all CPA values, and all of our specific rules really kind of branch from these particular values that we have here: objectivity, integrity, being free of conflicts of interest, and not subordinating your judgment. Okay, and so typically when I want to say something really important to my students, I'll say, put a star by it. Okay, and so typically we've got a few who are sleeping in class, and when they hear me say that, they'll wake up for about 2 seconds, put a star by it, and go back to sleep. And so this is one of those things that you need to put a star by, because this is the main values that we hold dear. And if we go ahead and uphold these, then it's very unlikely anything will happen as it pertains to our work. And the thing too that I think what people miss is CPAs are unusual people, in the sense that they're not like quote unquote normal business people. Normal business people can act in ways in general that will benefit themselves short of being illegal. I mean, they can't do anything illegal, obviously, but the CPA has to take a broader view, because we have a duty to the public, and that duty to the public is before a duty to even ourselves or to our employers or to our clients. And it puts us in a very awkward position, because our employers or clients are paying our salaries, for heaven's sakes, but there may come a time that if they are trying to do something that will manipulate the financial statements or cause other wrongful loss to the company, you're going to have to stand up to them. and it could mean negative consequences to yourself. And so this duty to the public in and of itself causes an inherent conflict sometimes between the quote unquote normal business people and yourself, because they don't understand why you're defying them. They're like, I don't understand this. And that's why sometimes CPAs walk around with a little bit of a target on their back. Those of you, I understand there's a good number of internal auditors here today. And I think you've always felt that probably your entire career, you know, that you're trying to enforce some rules, or you're trying to point out exceptions. And it doesn't necessarily make you the most popular person in the building sometimes, you know, because you're pointing out these mistakes. And so CPAs have to have the standard, and it's frustrating to others because it keeps them from maybe achieving their agendas. But if their agendas are contrary to fair financial reporting or fair tax administration, then the CPA has to say no. This is the other part that another quote from the AICPA: integrity requires a member to be, among other things, honest and candid within the constraints of client confidentiality. Service and public trust should not be subordinated to personal gain and advantage. Integrity can accommodate the inadvertent error and honest difference of opinion. It cannot accommodate deceit or subordination of principle. Okay, and so a couple things here. One thing that, you know, when I talk to my graduate students, and they all, I ask them, why did you want to be a CPA? They usually have a variety of reasons. Usually it's, oh, it's a good job, or I'm really good at accounting, or I've gotten a few, I'm so introverted that this is one of the few jobs I can do. Or I actually even had one guy said that he had was thinking about being an actuary major or an accounting major. He had to pick between the two. And he discovered that girls would not date him if he was an actuary major. And so apparently being an accounting major makes you a babe magnet in certain circles. That was a first for me, you know, wasn't quite, I did not realize that. But when they give all these reasons, but I said, really, the reason why you are being hired by these firms and being given these fancy, you know, entry-level salaries is because they are hiring you for your integrity and objectivity and good judgment. They're not necessarily hiring you because of your knowledge of the accounting or tax rules. Now, that is a prerequisite to being hired, of course, but they're hiring you as the person. Are you when it boils down to, are you a decent person? Are you a person with character? Are you going to stand up to things? And that's really what they're hiring you for. And that's part of integrity. And integrity means that you're going to be honest and candid, even when it hurts. Okay, you're going to tell it the way it is. Warts and all. And, you know, despite what many may say, there's no such thing as being partially honest and partially candid, okay? Because if you're being partially honest and partially candid, you're not being honest or candid. So CPAs have to go ahead and be very honest about what the financial condition of a company is. They can't hide it. And that's where there's a lot of struggle, because you may have some management who says, hey, we've got to make certain numbers. We have expectations, analyst expectations or internal metrics. And you CPA seem to be in the way. You're telling us no. And then that's where the pressure starts to build on the CPAs. And so, you know, we can't, but the deal is that we can't represent numbers, okay, or financial condition of our companies in a way that we wish the financial statements would look like, we hope the financial statements would look like. Under the best of circumstances, this is what the financial statements would look like. Okay, we just have to go ahead and say what it is, you know, once and for all, what it really is, and it may not be pretty. So I have an example to that. Okay, so of course, part of the reason why we're having this virtual conference is, you know, because of the pandemic. And one of the things that was really interesting when we first got shut down, you may have seen this as well, but all of a sudden, everybody, okay, so the lockdown happens, and all of a sudden on Facebook, I'm seeing all these business school professors like cooking like there's a different dish that they put on Facebook every day, and it started maybe innocuously like a patch of cookies or a muffin or two, and then it increasingly got more and more elaborate as they were trying to find things to do at their time or alleviate stress. And I was seeing things like Black Forest cakes after a couple of weeks, and all these exotic dishes, and beef burgundy, and so on and so forth. And so the joke is, because we were sitting around cooking and eating so much, we all gained the COVID-19, right? The 19 pounds. And so, like right now, I could tell you that I weigh 125 pounds after having, sat around and been in a lockdown along with the rest of you. But the fact of the matter is, it's not true, okay? And anyone who's seen me in person knows that I am not 125 pounds. But I could say, well, I want to be 125 pounds. If I had Oprah Winfrey's chef who can make weird stuff like tofu taste good, yeah, I'd weigh 125 pounds. If I had Jillian Michaels, the Biggest Loser trainer, have me work out with her for 4 hours a day, sure, I would weigh 125 pounds. Or, if I, didn't have a 9-year-old that I was making sure was staying alive, then, and got more sleep and had more time to, take better care of myself, I would certainly weigh the weight that I want to. But the truth of the matter is, I can't represent that. It maybe is what I want to happen, or what I wish would happen, or what would happen under best circumstances, but it's not what the truth is. And so I'd have to be honest with what that weight is, which I'm not going to disclose today. So anyway, but I think you get the point. Now, the other part of the EICPA that it talks about, as I'm setting up, the reason I'm talking about all this is because I'm setting up what should have been done versus what ended up happening in these fraud cases we're going to be getting to in just a moment. We have to, one of the things that the AICPA talks about is due care, okay? And due care meaning that we've got to go ahead and do our jobs very carefully. We've got to have the knowledge and the competence, and not just the competence and the knowledge, but being diligent, going ahead and, for instance, working hard and getting the job done that we're asked to do, not adding anything to it that's unnecessary just because it might line our pockets, but doing just what the client needs in a cost-effective manner. And basically the profession expects us to do a job quickly and efficiently in a timely manner, and for what should be a more or less fair fee, okay, and nothing more, nothing less. And because they can't have us not treating our clients well. Okay, it's time for polling question number 2. I think Patty now has the system set up. The due care principle under the AICPA Code of Professional Conduct includes which of the following? A, strive to continually improve competence. B, work to improve quality of services. C, discharge professional responsibility to the best of CPA's ability. Or D, all of the above. Okay, well, I think all of you were not born yesterday, and so I'm sure that all of you have gone ahead and checked D. Okay, it is all of the above. All these items are needed to show due professional care. Okay, and then finally, excuse me, this is probably one of my favorite quotes from the AICPA. A distinguishing mark of a profession is acceptance of responsibility to the public. The accounting profession's public consists of clients, credit grantors, governments, employers, investors, the business and financial community, and others who rely on the objectivity and integrity of members to maintain the orderly functioning of commerce. This reliance imposes a public interest responsibility on members. When I graduated, I horrify my students when I tell them this, but when I graduated for the first time in 1988, the students are like, gosh, I didn't even think there was math that big, to how many years I've been out. But, in my accounting program, it was a very good one. And I think we did talk a little bit about our responsibility to the public, but it's not as heightened as it is now. And I think some of this is post Enron and Sarbanes-Oxley, the profession, the AICPA went ahead and reissued this particular set of code of professional conduct in 2014, late 2014. And there was a very big push to go ahead and emphasize that we have a responsibility to the public, okay? And again, I'm glad that they have really put this to the first and foremost, because this is really what we're signing up for, okay? And I tell my students, you bear a great responsibility to the public if you have this job, and you have to be willing to sign up for it. And if you're not willing to sign up for it, for heaven's sakes, don't even get your license, because I wouldn't want you to get your license and have it stripped, okay, if you're not willing to do the job from the get-go. And so what this means is a lot of people depend on us to get it right, because not many people can do accounting. We all know that. Or frankly, not many people want to do accounting. They don't have the aptitude or the temperament for it. And people are expecting us to get it correct. And if we don't, then, really a whole lot of people suffer from it. Banks don't know whether to lend or not. And a lot of the capital markets start to falter at that point. And so, and we all have seen countries out there that they've got very weak accounting systems. Their version of FASB is not strong at all. There's very little clear financial reporting going on, and their economy is terrible as a result. You would never buy or sell on their stock market because it can't be trusted. And so, that's one of the fortunate things that we have. We do have a good capital market, and a lot of it is because CPAs continue to do their jobs and they continue to serve the public, even if it potentially could mean negative consequences to themselves. Now, most of the time, let's be honest, most of the time, you probably have a really good employer or a really good client, and they do want to do the right thing. They do want to engage in fair financial reporting. But if their agenda runs contrary to the public interest, then the CPA's duty is clear, and that's to go ahead and and to take care of the public. Okay, so let's go ahead and go to our first case study. And I'll have to tell you, I realize that I'm your last speaker before happy hour, okay, which is usually a tough draw because everyone's a little anxious to get to the fun. I want to let you know that my plan is in about 30 minutes to take a 10-minute break. We'll pick it up, and then my goal is to go ahead and end at 20 past 3, okay? And so I will take the time then at that point to go ahead and take a look to see if we have any questions that get put through the Q&A and try to answer those. But I promise that I will end in time, well in time for you to take a little break and come back for the wonderful happy hour that they have lined up for us. Okay, so let's talk about Buca Di Beppo. And some of you are familiar with this chain. It's a wonderful Italian restaurant chain, and I've been there and had some marvelous food there in years past when they had a restaurant in my area. And, the one thing about Buca, oh my gosh, they certainly got they got exposure that they didn't want. Okay. This is not the kind of thing that you want out in the public. What happened was there was the founder, Micatrato, and I hope that I'm pronouncing the gentleman's name correctly, but he was one of the founders of Buca Di Beppo, and he at one point had been the chairman and the CEO, and I guess he had retired and passed along the reins to somebody else. But meanwhile, Buca became publicly traded, and so as a result, they were subject to the Securities and Exchange Commission rules, and and that adds, as you all well know, a whole nother layer of scrutiny to the financial statements. I mean, irrespective of whether you're publicly traded or not, you should have financial statements that are in accordance with GAAP or IFRS or whatever, and that's obviously important. But if you are publicly traded, there's just a whole nother layer of scrutiny. And if you go ahead and defraud any of the shareholders, there are a lot of federal rules and penalties and sentences that could be imposed upon you. And it's far more onerous than maybe you would get through state law. And so that's why you have to be so careful in that particular instance. And so what was going on, you could see here the names of some of those who got indicted in 2006. Greg Goodell, who was the CFO, Mostenbacher, who was one of the controllers, and then the follow-up controller, the one who succeeded Mostenbacher, was Skripek. And so what happened here? Oh, good golly. When I was reading the SEC indictment, the charges being brought against him, I was shaking my head thinking, how could you let this happen? Or how, what were you thinking? What were you thinking was really kind of the long and the short of it. Okay, so what ended up happening? Well, Micatrato, I guess he had some sort of, influence still, even though he was a retired and somebody else was a CEO and all. But, you all know that if, for instance, one of the executives has certain expenses, the person who's probably going to approve those expenses is going to be the CFO at that kind of level before it gets paid. And so Micatrato somehow can manage to get through the expense reports a bunch of crazy expenses. You can see a list of some of them there, but he was charged with wrongfully taking $850,000 out of Buca's checking account to pay for a variety of items that there's no way, no how you could even argue that those were valid business expenses. His son's wedding, okay, remodeling of 3 of his homes. Somehow he managed to slip through that expense report the cost of an Italian villa. Wow. And then, of course, a huge number of cash withdrawals from ATMs, $131,000. And boy, he was clever doing this. I'm not sure how he did it, but $127,000 for airline tickets submitted for reimbursement multiple times, dog kenneling. And so, it was just really pretty obnoxious. And the deal is the CFO was the one who had the charge of looking through these expense reports, signing off on them, and then requesting from the controller to cut a check. And so, you're supposed to therefore, at some point, I guess you would argue that that's supposed to be adequate separation of duties. But I guess they were all in cahoots together because the CFO was willing to look the other way, and he did indeed approve these, bizarre expenses. And the controller, who should have also been a stopgap, was willing to go along with it. Okay, I understand the CFO is his boss, but they, a CPA in those particular instances needs to kind of put their foot down. They're going to say, hey, this is a publicly traded company, and we can't, we can't do this. I mean, you're ripping off shareholders, and we're all going to be held liable. But apparently that did not hold sway. So as a result, these really not valid, expense reimbursements should have been attributed to him as additional compensation. And so that's one thing that was not properly recorded. Goodell, who was the CFO, now he had his hands in the cookie jar also, because one of the worst things that he did was he ended up forming another company. It was supposed to be a technology company that was an outside consulting group, okay? And he gotten, I guess, in league with somebody else. And not surprisingly, Buca Di Beppo hired this technology company to do some work. And, Buca was kind enough to offer office space to these employees of this company. And, I guess there were a few people flitting around, here and there. But by and large, the technology services that they were contracted for never really happened in any large degree. And, but of course, Buca went ahead and paid for those huge invoices coming out this technology company. And of course, Goodell managed to get pieces of this. And It's unclear whether or not the controllers really knew what was going on or not on that particular score, but they probably should have. And so, and then a few other crazy things, went through the expense reports, such as $96,000 for his family vacations and visits to strip clubs. I mean, good golly, are you actually going to put that on your expense report? It just boggles the mind, that this was so blatant. And so anyway, as a result, Buca's reported income was way overstated. Okay. Because, that there was, they went ahead and capitalized a bunch of expenses, and certain items, of course, were just wrong that they went ahead and paid for. So that was a huge material overstatement of income, as well as having wrongful expenses going through there. And so obviously the shareholders were badly impacted by the wrongful expenses that Buca paid for. And then on top of it, the investing community was also disadvantaged because of the overstatement. So that doesn't go over well, basically, with the SEC. Mossenbacher got, who are these clowns that they were hiring? I'm not really sure, but Mossenbacher ended up getting kickbacks from suppliers. Okay. And then, but then he went ahead and paid them back for these giant kickbacks by allowing the suppliers to overbill. And part of the things that he received was 2 all-terrain vehicles and the use of an SUV. It just kind of went on. Well, not to be outdone, the subsequent controller after Mossenbacher was gotten himself in trouble for going ahead and paying those expenses that he should not have. I mean, he knew that those were illegitimate, and he went ahead and paid them anyway. Apparently, he was with Goodell at the strip clubs in a variety of locations, and so maybe he was just trying to go along with it. I mean, his hands were dirty as well. He wasn't just signing the checks, but he was also, involved in these activities that the shareholders should not have been paying for. And so, and you can see the rest of it there. So really, it's almost like I'm wondering if Netflix should go ahead and contact the powers that be and write a story about this. I mean, this is just incredible. Yes, it was an SEC indictment, and I was reading through these legalese and all the charges, but good night. I mean, it was like a novel, a beach novel, all this crazy stuff they were into. Well, anyway, as you can imagine, they all get indicted. I think the founder and Goodell got, I think, 8 years, if I'm not mistaken. Plus, they had to disgorge, all this money that they'd stolen, plus pay fines and penalties. The controllers got lesser sentences, but they still also had to disgorge, some profits from that. And, obviously for those who are, CPAs, they are never, ever, ever going to be working as an accountant again. And obviously they got their licenses stripped, and they all served some prison time. And so what an absolute disaster. I mean, and the SEC, Miss Thompson, I went ahead and put up her quote here, but basically it was her opinion as she was putting together these indictments, that it was the tone at the top. And, maybe it started with the founder, and if he was kind of walking on the wild side, and he was doing a little of, Austin Powers type of attitude, then, I guess he went ahead and hired people who were similar to him, and they went ahead and looted the company. So, again, if you're subject to SEC reporting requirements, especially so, then what they're saying is that you've got to have above board conduct, because, you cannot rip off the shareholders, because as she puts here, it's a fundamental violation of the trust placed in corporate officers by public shareholders, and it cannot be countenanced. So I think here, there was an override of the internal controls and the separation of duties. And really, the big problem here was just attitude, and what kind of people are you hiring to watch the shop? And apparently, didn't hire the best of the best. Okay. So here is our next polling question. When the public interest of transparency in financial reporting or fair administration of the tax law is in conflict with the agenda of the CPA's employer or client, the CPA must A, subordinate the public interest since loyalty to the employer or client is more important. B, try to resolve the conflict. If the conflict cannot be resolved, the CPA may need to resign. C, place public interest over the employer's or client's agenda, even if it means loss of job or the client. Or D, both B and C. Okay, well, I think you all know that the answer is, of course, D. It's both B and C. Okay, so you got to resolve the conflict, or if you can't, you're going to need to quit. And that's where it's tough. I mean, I'm not going to say it's a real easy thing because you've got to go ahead and say, hey, we can't do that. I can't do that for a variety of reasons. And some people are simply not going to like it. And it may mean that you may have to walk out the door. And it seems terribly unfair because after all, you weren't the one who started this, it's somebody else, but yet here you are having to take the repercussions. And that's very unfortunate, but that is something that we know may be a possibility when we sign up to be CPAs. Just like first responders, they know that it's very possible they'll be going into a dangerous situation at any given time. We shouldn't have negative forces in our world, but we do. And they realize that when they go to work every day, that they could be injured or killed, and that's just part of the risk they take. And so we CPAs, that is part of the risk that we take. It's in standing up and making sure that the financial statements are fairly stated or our taxes are properly paid. We could run to people who don't like that, and that could be a negative thing for us. Okay, so the AICPA also talks about threats to independence, and they look at many different, it states here that, a CPA does need to be independent, but there are sometimes things that can undermine our independence. And so there are 7 different categories: adverse interest, advocacy, familiarity, management participation, self-interest, self-review, and undue influence. And I think there's 3 items in here in this list that I think are more apropos than others. Let's start with self-interest. We have seen in other fraud cases, such as WorldCom, which I don't think that we'll probably be able to get to today, due to the time. But one of the things about WorldCom was these financial reporting accountants were just minding their own business. They did not want to commit fraud. They're just normal individuals. But their boss suddenly comes upon them. The CFO says, oh my gosh, we're going to miss analyst expectations. We need to fix this. Okay, and they were put on the spot right then and there. And in reading some of the books about WorldCom that were written about the whole situation, what really kind of comes out is that these financial accountants were normal, decent, ordinary people, and they were just like you or I, and they were suddenly challenged ethically, and they weren't ready for it. And so 2 of them that went ahead and caved and did topside entries that, basically manipulated the financial statements. They were the main breadwinners for their families. And they were in an area of the country that there weren't tons of other large companies around. So if they walked out the door, they were probably going to go to another accounting job that would pay a whole lot less. And, I get that, if you are suddenly accosted and you're not quite ready for it, sometimes your knee-jerk reaction is going to be one of fear. And I don't know about you, but whenever people make decisions out of fear, typically it doesn't necessarily end up being the optimal decision for them later on. Thinking with a cooler head, you're like, why did I do that? And so part of what, as a CPA, we need to be ready. Part of what will defeat self-interest is being ready for the challenge. Do you have a little bit of money saved up in case you got to walk out the door? Well, I know I'm probably, preaching to the choir because you're accounting types. Accounting types are always good at budgeting, it seems. Okay. So, but, do you have a little bit of money? Do you have a really good network that if you have to walk out the door, you've got people who will believe in you and will help you try to get another job? One thing that's great is here you are at the NRA at this conference, and it's a small world. It really, really is. The accounting world is, and I can tell you that I've been involved for many years with a tax group in town, and I've been involved with the leadership. I volunteered for different roles and that sort of thing. And so the one and only time in my whole career that I was ever laid off, because for 18 years, I never spent a day out of work. And then of course the Great Recession hits, I get laid off. And I've got a baby on the way, and it's 2010, and it's still hard to get a job. I'll tell you what, that network really came to my rescue. And I started making phone calls as I was driving home after just being told my job was being eliminated. And I'll tell you, it was really amazing, because even in the midst of the Great Recession, those folks scrambled around, and any interview that I qualified for, they got me lined up for the interview. And we all know that that's a huge, huge, huge deal. And so I was grateful for that. And because of their efforts, I ended up landing a job, I think, within 6 business days. We didn't have the contract 100% signed by then, but it was pretty much on its way over to me. And I had a job lined up before I even moved out of my old office. And a lot of it is just because of networking, and that networking doesn't happen overnight. So I'm glad that you all are here, because you get to meet each other, you get to know each other, and you build into the community, and the community builds into you. And so if you kind of have the money, you've got the network, you've got even another plan that you can go to in case this all totally blows up, it kind of puts a little bit of, I guess, resolution in you, right? Because you can literally walk out the door, and you've got a plan. You've got a plan that will help defeat self-interest. There's another one called undue influence. And undue influence, basically what that means is you are influenced by the people around you, whether you like it or not. Okay. Are you working for a place that is interested in being very moral? Do you have a good tone at the top? And if that's the case, probably the people around you want to do the right thing too. They're guided to doing that, and they want to. And I've worked for some places that were very straight-laced, almost annoyingly so, but they were eager to do the right thing. And I've also worked for places where it was a little bit more lackadaisical, and that actually showed up, I think, in some actions that people would take. And so, just be really careful, because if you're a moral person in a morally reprehensible environment, they are more likely to pull you down than you pull them up. Okay. The Wall Street Journal actually had an article out. It was about a year ago, I think. And the headline was, what is one way you can improve your efficiency? And I thought, wow, I'd like to know that. I'd always want to be more efficient. And apparently what it is that if you simply move your office next to the person who's the star of the office, there's always those who are just amazing, they're top-notch performers. And if you just simply move physically near them, that in and of itself is going to help your efficiency. And the reasoning was is that the star maybe knows how to, has a good thought process, or they know how to get things done more quickly, or they may have a really terrific work ethic, or, they just have ways of being very efficient, and you learn off of it. Okay. It doesn't have to be original ideas, but if you take the best ideas out of everybody and make it your own, people think that you're a total genius, even if you are borrowing some ideas. And so, but that is undue influence. So you can be influenced for the good or the bad. But I can tell you one thing is that your ethics never just stay the same. You're not ethical by accident. You're ethical because of deliberate actions that you take. And so And the good news is that if you're not where you want to be ethically right now, you can continue to make those good choices that will help you spiral upwards. Consequently, I mean, on the other hand, if you are not careful and you start to get a little bit sloppy or you get a little soft in how you do things, you can find yourself spiraling downwards. And because you're not, as I said, you're not ethical by accident. You know, it's because of deliberate choice. The last item is familiarity. That is the other threat to independence that I think is very insidious. And we're going to see this. We're going to see this illustrated in my next case study, which I will do after the break. But what is familiarity? Well, it's a little bit what I talked about at the top of the hour, where we talked about how you get to know people too well. You're part of the village. And what that is an enemy to professional skepticism. And some of it is, I've worked with this person for 15 years. I know everything about them. I know what they eat for lunch. I know the names of their cats and dogs. And I know the names of their kids. All this stuff. All the stuff about different people. But the deal is, we as CPAs are responsible for being professionally skeptical, and it's hard because not many people are skeptical all the time. It's a behavior that's not common to just normal people, so to speak. Okay. But we are not allowed to drop it. It's just, we have to make sure that we maintain it. I had kind of a funny story. This is about 4 years ago. I was teaching to a big group of internal auditors. It was one of their trade groups, and it was a big audience, probably about 75 people in a big auditorium. And so, there's usually some person who has the roll sheet, because, when I give a live lecture, we get everybody to sign in, and that's part of, making sure that we have attendance tracked. And so I asked, right at the beginning of the seminar, I said, okay, who's got the sign-in sheet? And this one guy waves. Okay. Now remember, these are all internal auditors. And I said, can you start passing the sheet around? Because I want to make sure we don't miss any signatures, in the course of this lecture. And this guy said, no, I'm not going to send it around right now because I want to make sure that nobody leaves early. So I'm going to send this sign-in sheet around in the last 30 minutes of your lecture. And I went, oh, wow, tough crowd. Okay. Because, it was something that you wouldn't expect to hear. We tax people. Maybe we're just a little too trusting, but we probably would have sent it around without thinking twice about it. But the funny thing was, even though that was kind of an interesting response by this man, I looked around and all the other internal auditors were nodding approvingly, because they're like, oh, that's a really good internal control. No problem. I mean, I wasn't going to leave early anyway. So put me to the test. It's not going to bother me. And, I was kind of laughing a little bit but the deal is that, especially internal auditors, they have to be skeptical. That's just part of their persona. That's part of their jobs. And that's front and center. They were not offended by what this guy putting internal controls in place. They weren't offended at all because they get it. And that's the language that they talk. And we CPAs, the problem we have is that we're around quote unquote normal people who are not skeptical all the time. And if you're skeptical all the time, it really annoys the heck out of people, because they feel like you don't believe them. And it's not that you don't believe them, but it's your job to make sure that you verify everything that happens. Okay. As we're going to see, if one of your internal controls is trust. Oh, I trust them. That's an internal, that's your version of an internal control. There's a big problem there. Okay. Because trust is not an internal control. We all know that. Okay. But unfortunately, with familiarity, people don't realize it, but they're falling into that trap. Okay. So what I'm going to do, I'd like all of you to go ahead and set your alarms for 10 minutes, 10 minutes. I'm going to go ahead and do the break now and jump on in this. And then we are going to go like lightning, try to cover as many case studies as we can. And then, as I said, I promise I will stop in time so you could get to happy hour without delay. All right. So we'll go ahead and start our break now.
We'll see you all back at 2:34.
get those beverages close by, we'll go ahead and keep going so that we can end on time. And then, as I said, enjoy the wonderful happy hour they've got available for us afterwards. Let's go ahead and talk about the City of Dixon, Illinois. And this was a very, very interesting case study, only from the standpoint that while this did happen to a municipality, I think any of you who work for instance, a smaller organization, maybe even a company that's growing fast, but they're still kind of a little on the smaller side. But what's happening is they're growing fast, and they're maybe not quite keeping up with the separation of duties and all that, and some of the internal controls. And how when you look at this case study, you could see how easily it may happen where you are, depending on your particular situation. And that this is one of those things that I say, I can say this because I'm here with my peeps, my fellow accountants, that you're not going to think I'm weird by saying this, but there is a really, really good documentary out there that talks about this particular scandal, which broke in 2012. And the name of the documentary is called All the Queen's Horses, All the Queen's Horses. And it's available on Amazon, but I think it's also available on other channels as well, like YouTube or something like that. And it's very well worth your time. Don't be afraid that it was that the producer and director of this documentary was an accounting professor, because it's still actually incredibly interesting. And I think if you're with a small organization, this should be must watch show, because I think you're going to look at it and you're saying, wow, I could see how this could happen to me, and because there was a variety of things that went wrong here. Okay, so what happened here at City of Dixon, Illinois? Well, in 2012, the news broke that the controller of this municipality, the controller / treasurer, a woman by the name of Rita Crundwell, she had just been apprehended for stealing $54 million from this small town of 16,000 residents. And she had been stealing money for over 20 years, and nobody had figured it out. And so the way this story, well, let me back up and say this was the largest fraud case of any municipality to that point. And the biggest fraud case prior to that was one of 48 million stolen from the city of Washington, D.C. And, if you kind of do the math of the number of residents in Washington, D.C. and, divided that into the 54 million, that equates to about $80 per person. Okay. Not great, but not overwhelming either. For the City of Dixon, Illinois, it was only one person who committed the fraud unilaterally. And when you divide 54 million by the 16,000 residents they had, that was a theft of $3,300 and change per man, woman, child. Okay. So with my family of three, that's like asking me to write a check for 10 grand and hand it over, which, if somebody asked me that, I'd tell them to go jump in a lake or something, So it was just astonishing, the level of theft that occurred. So how did this all happen? Well, there's several issues that came into play here. One of them was the way that the city was set up. They didn't have a lot of full-timers there at the city hall, because it's a small town. And by the way, Dixon, Illinois also happens to be the birthplace of Ronald Reagan, the president. Also, when you look at pictures of this town, I mean, it's just beautiful. It's a bucolic little town, and a lot of people know each other, and it's very rural. There's a lot of farms and ranches outside of there. And so, it seems too idyllic of a place for something this awful to have happened to it, but it did. So part of what happened was, that, as I was saying, they didn't have a lot of full-timers in the city hall. It was really small. And the city council actually, they were very much part-time. This was all the city council members plus the mayor had full-time jobs, and which is not uncommon with very small towns. They were paid a little stipend of some sort for their work for the city, but it was mostly something they did out of civic pride, not out of any type of monetary inducement. And so as a result, when it came to looking at, say, the financial statements and what have you, they would rely on the full-timers. And I don't know about you, but nonprofit accounting or governmental accounting, I never really understood that, and you had to be fairly clever to have, figure all this out. And so the council members and the mayor would just rely on, their full-timers to go ahead and interpret, prepare the financial statements, prepare reports, and tell them what was going on with these reports, as opposed to being able to independently verify the financial condition of the city, or dig deep into the details. They simply didn't have the time, or maybe even the aptitude, since they were from non-accounting backgrounds. And so and it's confusing enough as it is. And so Rita herself actually was a very clever woman. And her background was she had grown up in Dixon and graduated from high school there and started working for the city nearly out of high school. And so by the time all this stuff, the scandal breaks, I mean, she'd been with the city for over 30 years and everybody knew her. Her parents had a farm, by the city limits, and everybody, knew her from the time she was even a girl. And I think part of that deals with the familiarity that I was talking about before the break. They were so familiar with her that they just trusted her, and this is the city. Everybody loves the city. Everybody wants the city to prosper. And so that comes in with the whole issue of the trusted insider that we talked about earlier. And so what had happened was, because there were so few full-timers in the city, and they didn't really focus on anything called internal controls, as it turned out, Rita had the following powers, okay? She had the power to approve an invoice. She had the power to remove money or transfer money from the big general account into one of 6 sub-accounts that they had at the bank, okay? So they had like six checking accounts merely as budgeting or reporting devices, honestly. So say, for instance, you got an invoice in on sewer repair, okay? She could approve that invoice. She would move money from the general account to the checking account for sewer repair. And then she had the power to write a check out of the sewer repair account to pay for the invoice. On top of it, she was the one who put that payment as a journal entry into the books. And then she was the one who also got the bank statements, and she reconciled the bank statements to, the cash account and all the other accounts. And so, if you're an internal auditor, you're probably sitting around scratching your head saying, wow, how, is there even another duty to separate at this point? Does she have the whole kit and caboodle? And the answer is, yeah, she did have the whole kit and caboodle. And so there was no separation of duties. So you could see how easily it would be. She could easily rip off all this money, because what she did was she had dealt with the bank who had the city's accounts for a zillion years, and they allowed her to go ahead and set up this 7th account that nobody knew about. And I don't know about you guys, but the last time I had to set up a business account, they asked for every document under the sun. I mean, I had to show my bylaws and, the document that I got back from the Secretary of State, and franchise returns, and so on and so forth. I mean, they wanted to know it all before they would set up an account. But because this bank had known Rita for such a long time, they just went ahead and set it up. They just didn't think about asking for a second person at the city to authorize the setting up of this account. And I mean, they just did it. And again, it goes back to familiarity, and being in a small town and everybody trusts each other. So she set up the seventh account. She went ahead and put together fake invoices, which again, she had the power to approve. She had the power to, move over the funds, write the check, and then she was off to the races. And so, as it turned out, later on, they found that she had written 179 fake invoices, and some of them were obviously fake. Okay, they just didn't look real if you were to scan them. And that kind of came into play with why and how the accounting firm, a regional accounting firm that was the external auditor, had ended up having to pay a huge settlement because their during the course of the external audit, they should have picked up on some of these really, really big invoices, but they didn't, okay? Because had they picked up on it at some point over the 20-year period, they would have traced that invoice through the system and realized that the expenditure was completely illegitimate. And so anyway, but no one was watching her, and she pretty much had her hand in the cookie jar. And so the first few years, like you would expect, she stole relatively small amount of money, okay? And no one figured it out. So of course she would get bolder and bolder as time went on. And so, ultimately, towards the last few years, right before she got caught, that was where she stole the bulk of the money. And it was during the middle of the Great Recession when this was all happening, and in the midst of it. And, everybody was suffering during that period of time. And here she was taking all this money out. Well, what in the heck was she doing with all this money? Well, she was she liked to show horses. And so she would, buy all these high-end horses. She would show them and breed them, and then and she won a lot of awards for doing so. And but I don't know if any of you know people in the horse business, but typically when you're in the horse business, it's kind of unless it's a very rare circumstance, generally you're more likely to lose money than you are to make money. It's one of those love affair kind of jobs, and she loved a horse show. And I think people just assumed that because she was so good at showing horses, that's why she was living so high on the hog. But I mean, she had a luxury horse ranch or a horse farm in Dixon. She had a luxury home in Dixon. She had a condo in Florida. And to go to these horse shows, she had a $2.1 million RV that she would drive around. I'm like, a $2.1 million RV, good night. What is in it? I mean, that's like a Taylor Swift kind of RV, but I just can't even fathom having a motor vehicle that expensive, but I guess when she wanted to go to horse shows, she wanted to do that in style. On top of it, her horse trailer itself was $250,000. And I'm thinking in my head, good golly, this horse trailer better be air conditioned and have a television in it if it's going to be that expensive, because that's more than some people's houses. And so it was just really, really crazy. And no one really questioned it. I mean, if she's going to live that high on the hog, what in the heck is she doing keeping an $80,000 a year job? It just kind of boggles the mind. But no one really questioned it. I mean, she had explained at one point that her parents had bought Campbell's soup stock and had made a fortuitous investment. And, I guess people accepted that explanation. But, her parents were still in the area, and they lived very normal middle-class lives and on the farm. And it was just, people just weren't adding all these things up. And there were a few other red flags that people should have noticed. One of them was the city manager of a sister city called Sterling, Illinois, which was about an hour or so away. He noticed that Sterling had like a $5 million surplus. And they had the similar tax base and similar operations as Dixon, Illinois. So Sterling had a $5 million surplus and Dixon had a $3 million deficit. And they were always floating these bond issues to get more money because they needed the work done. They didn't know where their money was going, why things, why there was still a lot of repairs that weren't being made or what have you. And they just continued to go ahead and borrow money. But guess what? Rita was taking that money and putting it right in her pocket. So how did she get found out? Well, she got found out. It was actually more than simple. She was out of town one week, and her subordinate needed to go ahead and put a report together. And she normally would ask Rita for the bank statements that she needed, and Rita would just simply hand them over, and this lady would get her report done. Okay, well, Rita wasn't there. She couldn't quite remember which account it was from. She knew it was in a particular time period. So she thought, well, since Rita's here, I don't know what she did with the bank statements. Rita probably had them locked up somewhere. She called the bank and said, hey, I need all the bank statements for all the accounts between this date and this date. And so they just sent them on, and they sent over not just the legitimate the statements for the 6 accounts that were legitimate. They also sent over the statements for that 7th account, that 7th secret account. And so the minute that her coworker saw that 7th account and saw the money going in and out of it, she almost figured it out almost immediately what was going on. And so she tells the mayor. The mayor goes ahead and calls the FBI, and they basically put Rita under surveillance, and they wiretap her phones and so on and so forth. And basically they ultimately got the information that they needed to go ahead and prosecute her. So they went ahead and seized all her property. And when they seized it, they discovered she had, counted, 400 horses being stabled over 13 different farms, along with all the rest of that crazy amount of property that I told you about, including nearly $400,000 in jewelry. And it was just unbelievable. So they went ahead and seized all her stuff. They auctioned it off, and they got about $10 million. Okay, so she stole $54 million. They only got $10 million back on auction. And then they went ahead and sued the bank and the external auditor, because the external auditor, in addition to not catching some of those huge invoices that they probably should have picked up on, they had also, I guess, petitioned the city to let them do some back office work. So they were doing some payroll and some other things, and they were putting entries into the financial statements, and then they were on top of that doing an external audit on those financial statements. So essentially they put themselves in a position to audit their own work. Okay, and they missed the wrong invoices, and so they, along with the bank, paid a total of $40 million in settlement. Okay, so of the $40 million in settlement, $10 million went to the lawyers who brought the suit up. Another $20 million of that went to pay off all those bond issues where they borrowed money, but of course Rita was taking it all. So the city was finally left with the $10 million they got back from the auction and the remaining $10 million they got from the settlements. They only had $20 million to attempt to get all this work done. And it was just a really sad situation. She ended up being, she was in her early 60s when she was prosecuted. And I believe that she got a 27-year sentence or something like that. It's essentially a life sentence. And it was just a sad situation. And sad for her, of course, but gosh, the city was badly impacted. I mean, this was really, really a terrible situation. So, a lot of lessons to be learned, paying attention to those, the separation of duties, making sure your external auditors are up to the job, that they are clearly, auditing in the way that they should, and making sure that, the service providers such as banks and whatnot, they go ahead and, go along with the internal controls that are expected. One things that I'm always focused on this particular case is that, I teach Principles of Accounting 1 to, some undergraduate students. And in one of the chapters, we talk about, internal controls. And I probably maybe spent, 15, 20 minutes max talking about separation of duties. And the sad thing is, if they had just merely implemented simple separation of duties, I don't know if it would have stopped all the fraud, but it probably would have stopped a whole lot of it. And it would have, at a minimum, slowed it down, and all it would have taken are these very simple concepts that they opted not to do. Okay, so let's now look at polling question number 4. Which of the following factors led to the $54 million fraud that occurred at the City of Dixon, Illinois? A, failure to separate duties. B, the city's banker who permitted Crundwell to set up an account without a second signatory. C, external audits failure to flag obviously fake invoices and to thoroughly examine internal controls. Or D, all of the above. Well, I think you all can pretty much figure out the answer, of course, is all of the above. Okay, so please make sure you answer that so that we can record your attendance. All right, so here we go. Here's the next one. This is Collin Street Bakery. And gosh, this was yet another sad situation. And again, this one, I think, was more, you had a small company that was really expanding and doing really well, and the internal controls simply failed to keep up. And then you also had, again, it goes back to the whole role of the quote unquote trusted insider. Okay. And we who are professionally skeptical, there is no such thing as trusted insider in our vocabulary, right? Because with professional skepticism, no one is to be trusted until you verify, right? And so this was an interesting story. It's actually, I don't know if the movie's still slated to happen, but it was Will Ferrell and Julianne Moore, I believe, who are going to play the parts of Sandy Jenkins, who is the CPA who stole all the money, and his wife. And this was an interesting story. Okay, so those of you who are not familiar with Collin Street Bakery, let me tell you a little bit about it. And we Texans have I bet most of you have heard of this particular bakery. They've got these great restaurants all along the big highways like I-35 and I-20 and I-30, and lots of yummy stuff. But they had a very interesting history in that in the turn of the last century, there was a lot of German immigration to Texas, and there were these two brothers who came over from Germany. And, it was one of those deals that the folklore is they had their secret recipes sewn into the lining of their jackets, so on and so forth. I'm not sure how much of that to believe, but part of one of the recipes they brought over was this thing called fruit cake, which was a cake often made, around Christmas time in Germany. Anyway, so they set up in a town called Corsicana, which is about 50 miles southwest of. Let me think about that. No, it's southeast of Dallas, and they just, as I said, opened up for business. Now, what was an issue here was there's no refrigeration during that period of time, and the Barnum and Bailey Circus was coming through town fairly often, and they discovered this fruitcake did not need refrigeration and it would stay fresh for a good long period of time. So they started ordering a lot of it as they passed through town, and then they liked it so much they asked for them to send it on to their families wherever they were, and so it made a nice little gift. Well, before you know it, everybody wanted the fruitcake, and so they pretty much shut down the deli and all the other things that they had started, and they just started baking things, including this famous fruitcake. And so the brothers ended up selling out to the current family that owns it, and I believe it was the 1930s or so, and might have been a wee bit later than that. But the family that bought it, and their name is, I'm not kidding you, the McNutts. the McNutts. Okay. And so the McNutts are now on their 4th or 5th generation of family members running Collin Street Bakery, and they have become wildly successful. You know, they started off as this little local bakery, and now they are in many, many locations, and they're especially their fruitcake sales are just astonishing. They have shipped fruitcakes to something like 97% of the countries out there. They have listed as their clients every single major royal family on the planet, and all sorts of luminaries buy this fruitcake and send it to their families and loved ones. And, you know, there's always this joke about there really being one fruitcake in the world, and, you know, everyone's just regifting it to each other for the next 25 years, and it's making its way around the globe. But, you know, and I have to say that I'm actually not a fruitcake fan, but this stuff is really, really good. So if you have a chance to try it, you probably ought to. Okay. So where does the story come in? Well, a number of years ago, they hired a man by the name of Sandy Jenkins, who was he was raised locally, and they hired him to be a staff accountant, and he proved himself to be very capable and very efficient. And before you know it, he ends up as the controller. And so this entire saga was presented in a long article in Texas Monthly a few years ago, and they said that, you know, Sandy had been there for quite a while, and he was doing well, very solid middle class life, and you know, nothing to complain about really. But according to this article, you know, I don't know, Sandy may be having a midlife crisis or something, but there was an issue where he just felt that he was being, I guess, underappreciated, or life wasn't bringing to him what he had thought or what he thinks he should have. And so, you know, and here the McNutts were being extremely successful. And so what Sandy found out was that there was a flaw in the check writing equipment, or the software. And what he found was he could write a check seemingly to a legitimate vendor. Let's say he wrote a check for $20,000 to one of their vendors, you know, Ben E. Keith or something like that. And then he found that he could cancel that check and reissue another check for $20,000 also, but he could put in a different payee. Okay. So, but the problem with their check writing system was it would only record the amount and the payee from the original check, not the replacement check. And so when he had the replacement check and he wrote it to, say, his Visa credit card company, okay, all the system would show is that a $20,000 check had been cashed, but the payee still remained, you know, the vendor. And it didn't show up this illegitimate replacement payee. Okay. And so that's how he started ripping people up, because, you know, it looked like everything was fine. All the checks were being supposedly cashed by legitimate business partners of the company. Okay. And so they didn't know that he was writing it to, you know, his local Lexus dealership, or to one of the luxury department stores, or whatever. Okay. He was spending money like crazy. And so he you know, before you know it, this guy who had really just an ordinary job was flying on jets and had a condo in Aspen, and got into luxury wine and you know, fancy foods, and started driving very expensive cars and replacing them, you know, fairly frequently. Was wearing expensive watches that, you know, he, at one weekend he bought 2 or 3 very, very expensive designer watches with, you know, pave diamonds on it or whatever. And that was more than his normal annual salary. And his wife was dripping with jewels and furs, and they had bought a much nicer house in town, and so on and so forth. I mean, you can just kind of fill in the blank, and nobody knew anything about it. And the McNutts were so puzzled during this period, because they were working harder than ever, and they were having more success than ever on their expansion. But there was just seemed to be nothing to show for it, and they just could not understand it. And so ultimately what happened was Sandy had hired a young accountant to help him with, some of the lower level accounting work. And she was just out of school for 3 years. She was a very young accountant, and she was flipping through the canceled checks one day, and she discovered some of the checks were for payees. Like one of them was to a bank that Collin Street did not have an account over at that particular bank. And so she got very puzzled, and she started digging down a lot deeper. And then she discovered all these crazy checks being written to, car dealerships and the, high-end department stores and what have you. And she's like, there is something really, really wrong about this. I will tell you, just FYI, this is an interesting story, and I believe someone like American Greed or something like that has put on a documentary on it, and I think you could probably find out on YouTube or wherever, but it is a very, very interesting story when you look at it. So with the young accountant having discovered there's a problems with the canceled checks, she obviously goes to her boss's boss and says, what the heck's going on? And it doesn't take them long to figure this out. And they discover that over an 8-year period, Sandy had stolen, counted, $16.4 million from this small family-owned business. And it was unbelievable. So obviously, this completely unravels. Sandy is obviously arrested. They seize all his property and they put it under auction, and they only get $4 million back. And so the McNutts have effectively lost $12 million. And you have to think about it. Collin Street is one of the biggest employers in that town. It's not a real big town. And they, their fruitcakes are so popular. In October, they start renting out kitchens from other restaurants, and they go 24/7. They hire all these people to, help during the Christmas season, and because they need all ton of product, and it all needs to be fresh. And if Collin Street went down, that would really be devastating to the employees, because there's not a ton of other employers, of that size in Corsicana, Texas. And, it's not just the employees who would be hurt. It'd be the family members of those employees that were hurt. So, as I said, they arrested Sandy. He was prosecuted. He got, I think, 11 years. And, he went on to jail. Now, this is the sad part. About a year ago, I was looking at the newspaper, and apparently Sandy Jenkins had died in jail. He was at one of the prisons near Fort Worth, and he'd been taken over to one of the hospital wards and had died. And he had only been in jail, probably just a few years, 4 years, maybe, or less. And so in terms of age, he was probably in his late 50s. And they didn't say exactly what he died of, but it was just a sad situation. Interestingly, his wife did not get prosecuted. I think the feds either couldn't prove it, or they bought her story that she just didn't know that Sandy had told her it was his rich uncle who had died and left them lots of money, and that's why they were doing this. But, again, it goes back to, if you're going to live the life of the Kardashians, then what in the heck are you doing keeping this modestly paying accounting job if you're going to be living like that? It's just some things you need to add up, and it needs to make sense. And if it doesn't make sense, you may need to investigate that. Okay, so all right. Let's see. Here is polling question number 5. Sandy Jenkins' $16 million fraud of Collin Street Bakery was a result of which of the following? A system flaw in the check writing function that allowed him to hide the actual payee. B, the CFO insisting that the canceled checks be kept in Collin Street's records. C, an attentive accountant who noticed that the payee on a canceled check was not one of Collin Street vendors. Or D, proper separation of duties which were maintained. Okay, so I think that, when you look through the answers, you can pretty much see that the answer is it was A. Okay, So it was a system flaw in the check writing function. Okay, the rest of it would hopefully be factors that would help you defeat this kind of fraud occurring. Very interesting story. I'm looking forward to finding out how they're going to handle this when it comes to the movies. All right, so let's now go ahead and turn our attention to the American Cancer Society of Ohio. And this too also goes back to the theme of no separation of duties. Well, actually, to be honest, they had internal controls, but they were being roundly ignored by the vendors, in this case, a bank, and then internally, they were not really examining whether internal controls were being even followed. Okay, so it's not like they didn't have them; they just were not used, and that was really unfortunate. So here's the story. This one is an interesting story only because of who ends up being the heroine at the end of the day. American Cancer Society of Ohio, one of the, I guess, divisions, I guess you would call it, of the American Cancer Society, had hired a number of years ago a young man by the name of Daniel Wyant to be basically a entry-level computer guy, no one with a lot of actual power. And so they had done like a little, I guess, background check on him, but it was background check light. I mean, maybe they just checked his credit score. I don't know what, but I guess they thought, well, if he's just entry level, it's not going to matter. Well, Daniel was very talented and very, very bright. And so within an 8-year period, he ends up going from the computer guy onto being essentially their chief financial officer. They called him the chief operating officer, but he had all the powers of a chief financial officer. And so, he'd been around the organization a long time. And one thing is they had not updated the background check. And had they done so, they would have realized they were letting the fox into the hen house. So because as a very young man, he had been arrested for forging checks. And then in addition, he had been accused of embezzling, I guess it was $21,000 from a Hawaii food bank. And so clearly you're not going to want that person being in charge of your finances. But they missed it. And so Daniel actually, many years later, after all this kind of blew up, he was being interviewed and he explained what led to his stealing essentially $8 million. He said that he was the type of person that could master information really quickly, and then he would kind of get bored. And then when he was bored, it kind of made him dissatisfied with life. And then if you're dissatisfied with life, then it made him wonder whether there was something better out there for him, and so on and so forth. And it made his thoughts go down kind of the wrong direction. So this is kind of what happened. He was at the top of the heap there at American Cancer Society, and he was a little bit bored. And so he started thinking, well, what happens? Surely there's something else out there for me. What happens if I go ahead and get some money together, and then we can start off a new life and kind of start over again? And so that's what he did. He went ahead and slowly siphoned $8 million off of their accounts. Now, this is the deal. He had the accounts transferred to a bank, and the bank that he was dealing with was one that dealt with the Cancer Society all the time. And it was another situation. They were supposed to have 2 people approve the setting up of another account from the Cancer Society, but the bank had dealt with Daniel such a long time. They said, oh, well, Daniel, we'll just set this thing up. And they saw the internal controls as pesky and a hindrance, as opposed to what they are, which is to be a help and a protection. And so they set up that account. Daniel starts to move this money. Again, he's supposed to have a second approval from his organization before money can be moved. And again, that was ignored, because again, they're just pesky, those internal controls. And so at some point he gets his $8 million together, and he decides it's time to pull the trigger. And so he pretends to go to work, but in reality, he goes to Austria. He had done, I'm not trying to give you guys ideas or anything, but he had done some research, and it turns out that if you go to certain countries, you can it's hard for you to be extradited back, and so he found that Austria was a good place to run off to if you're going to steal that kind of money. And I guess they have their hands full dealing with their own criminals. They don't want to have to chase after another country's criminals and send them on back. And so he goes to Austria, calls his wife from Austria and says, I've got the money. This is what I've done. Please pack up you and the children and meet me here, and we will start a new life. And, because they had 2 very young children in the home at the time. I think it was 2, might have been more. But anyway, well, of course, she's shocked. She had no idea this was happening. And so what she did was, she was utterly stunned, and she said, what have you done? And I'm sure that her life flashed before her eyes at that point. You have to think about it. She knows that he's committed a crime, and if he gets arrested, I mean, he's going to lose his job, go to jail, and those are all terrible things, and it's going to be terrible for her family because everything's going to change at that point. And I'm sure in the back of her mind, maybe she might have been a little tempted to go ahead and just join him. I mean, that would almost be the path of least resistance at the time, at the moment, because they would have the funds to be able to live. But thankfully, she was a woman of character, and she was also a woman of wisdom, because she realized that, you go on the run like that, you're always looking over your shoulder. You'll never be able to be in contact with your family ever again, really. And that's really no life to lead. So what she did is essentially, after trying to report this to the police, she ends up with getting in contact with the FBI, and gives them the permission to tap her phones. And so Daniel's calling her, trying to convince her, and she's getting him in these conversations, essentially knowing that the information she's getting from him over the wiretap phone is going to help them prosecute Daniel, and that's got to be heartbreaking for her. But she knew it was the right thing to do. So essentially, she gets enough information to where they've got a pretty good case against him. And then she tells him, okay, we've been wiretapped. They have all they need on you. And if you voluntarily get on a plane and turn yourself in, we will stand by you. But if you go on the run, you will never see me or the children again. And thankfully, I think he understood the common sense that she was saying, that he wasn't going to be able to get away with this. And so he indeed went ahead and got on a plane and turned himself in. And that was a good thing for him. And, I have to give her a lot of credit. She had to show a lot of courage and a lot of moral fiber to do something like that, because that was really, really hard, and it was going to cost her something. And I bring up this whole case study for a couple of illustrations. One about the internal controls, of course, that were roundly ignored because of familiarity. But the other one is she kind of represents the attitude that a CPA may have to have, right? You've got to make sure that the right thing happens and you take a stand on it, even if it's going to cost you something. And this certainly cost her a lot. Okay, polling question number 6, and we just have a few minutes. So what I'm going to do is we're going to do some polling questions so that I can get all those in. Daniel White's theft of the $8 million from the American Cancer Society of Ohio was facilitated by which of the following? A, failure by the ACS to perform a more extensive background check once Daniel was elevated to a position of great power and responsibility. B, failure by the banks to adhere to internal controls. C, both A and B, or D, none of the above. Okay, well, I think that you all know that the answer, of course, is going to be C, both A and B. All right. The Baptist Foundation, we just have a few minutes left, so let me go ahead and talk about this. And again, as I said, we'll try to get a couple polling questions in. The Baptist Foundation of Arizona, this was a heartbreaking case study, and when it went ahead and imploded, you probably didn't hear about it. This was the largest bankruptcy of a charitable organization up to that point. It was $500 million, I think, that had been lost, although they were going to be trying to recover some of the amounts. Okay. And so what happened here? Well, the Baptist Foundation had started off being run by some very conservative money managers whose main focus were people who were, say, for instance, ministers or church workers, to help them save for retirement. And they were going to be very conservative, try not to lose any principal, and try to get these ministry individuals a better return on their money than they would on their own, and give them good advice. And that worked out fine for a long time. And eventually they opened up essentially this hedge fund to members of the congregation. So if you're affiliated with this denomination, you had the opportunity to join in. And so they had a lot of congregants join in as well. And you can kind of imagine who they may be. I mean, you may have grandparents that are like this. And so there was just some hardworking, individuals who had been devout and frugal all their lives. And they decided, hey, if the Baptist Foundation is offering money, then we're going to join in on them. And they're being audited by Arthur Andersen, for heaven's sakes, and they're probably in pretty good shape. And so there was a lot of people who went ahead and invested. Well, the problem is the money managers, the original money managers, had retired and turned it over to a new generation of money managers, and those guys were really aggressive, and they weren't conservative like the previous ones. And they did a big bet on Arizona real estate, which unfortunately the bet turned out wrong. And so at one point, the balance sheet was underwater by about 40% of the original investment. And they should have just told them, hey, we've lost part of your money. Okay. But the problem was the person in charge was this man by the name of Bill Crott. He did not want to tell them, not because he was going to make any money off of that per se, but it's because he couldn't admit that he had failed. And so his rationale was, let's hide the fact that we've lost their money. We'll set up a related organization that's going to issue a fake notes receivable so it doesn't look like our balance sheet's underwater. And we're just going to wait for this real estate to go back up in value, because it will. I mean, they don't make dirt. They've stopped making dirt, is what everyone always says on these real estate deals. Well, this is the deal. We talked about how a CPA needs to be honest and candid. And Andersen did not know about this fake notes receivable initially, but then they did find out about it. And I actually had met this person who was the staff auditor on this. He was, as it turned out, when this whole thing blew up and people were getting arrested, he was the only person on his whole team on Arthur Andersen who did not get indicted. Okay. He was witness for the prosecution because he actually, even as a young staff accountant, did the right thing. He had documented when he had discovered that the fake notes receivable was unsecured, and he went ahead and noted that in all the work papers. And even though their partners had tried to destroy some of the work papers, because they still found one of his smoking guns in there. And it was really a sad thing because Andersen did not blow the whistle on this and pull out their unqualified opinion, because they decided they were going to be friends to the client. If they went ahead and pulled their unqualified opinion right then basically they would be underwater, and the Baptist Foundation would go bankrupt immediately. So they thought, well, we won't pull our unqualified opinion. We'll give them some more time for this real estate to go back up, and no harm, no foul. Okay, is the role of the external auditor to be a friend to the client? Well, no. And so anyway, as a result, they should have pulled the plug on their opinion. At one point, they continued to give unqualified opinions and signing off on the financial statements for 2-3 more years. Meanwhile, about $220 million more of investment came in during that time. And had Anderson gone ahead and pulled its opinion, that $220 million wouldn't have come in and those people wouldn't have lost their money. Well, who was the loser of this? It was the investors. Who were the investors? Mostly elderly people who could not get jobs and work again. And I mean, you can probably relate. You may have parents or grandparents. You know, I can relate because of my mother. But you know, how stressed out would they be if they lost pretty much 60, 70 cents on the dollar of their nest egg, their retirement nest egg? Very stressed out. Okay. Ultimately, Anderson did pay a settlement amount, but you know, those things get stretched out for years. And think of the level of stress that was going on with these individuals wanting to know whether they could even pay their bills. And it was just horrible. And it's because Anderson wanted to be a friend. Okay. You're not a friend. You're not a friend to the client. That's just not how it works. And as a result, these people were highly disadvantaged. And it's just a horrible story. And it happened at the same time as Enron, but no one heard about the Baptist Foundation because Enron was such a big blow up. And the sad thing was, the one thing they had in common was their external auditor, which was Arthur Anderson. Okay, so let's go ahead and go into our next, we're almost out of time here. Let's go to polling question number 7, and then I'm going to go directly then to polling question number 9. We're going to skip polling question number 8 in the interest of time. So let's take a look at this. Arthur Anderson failed in its duty to the public during its audit of BFA by which of the following actions? A, not following up on the information provided in a number of whistleblowers. B, finding it more important to be a friend to the client rather than apply the current accounting rules. C, not acting on their investigation of the security of a related third-party note. Or D, all of the above. Okay, well, I think you all know it is D, all of the above. Okay, so Patty, we are going to go on to polling question number 9. Let's see, let me go down here. Here it is. I want to make sure that we get our polls in. So again, I don't want to get between you and a cocktail, so we're going to finish up here. Which of the case studies did you find most interesting? And now we didn't cover all of these, but go ahead and select the one that you like the best. Buca Di Beppo, Baptist Foundation, American Cancer Society, Collin Street Bakery. And we did not get to WorldCom. So go ahead and pick one of those, because I'll be real interested in finding out which one you liked. Okay, as you are finishing that up, I just want to go ahead and thank you for having me speak to you today. I was so thrilled to get the invitation to talk to your organization and also to present this really kind of interesting material. The last thing I'm going to leave you with is, remember, if you're saying, I trust, let's see. Oh, okay, so you guys like Buca and you liked Collin Street Bakery. Okay, that's interesting. That's good. I'm glad you like that. So if at the end of the day, if you find that you are saying to yourself, trust is my internal control, please have your antennas go up, have the red lights flash and say, uh-oh, I am lulling myself into a sense of complacency. And if I don't go ahead and do something about this, we're going to have, you know, we could have a disaster like what we just, on one of these many case studies that we've talked about. So again, everyone, thank you so much for being here. Hopefully, Lord willing, I will be seeing you sometime soon at another program. And I wish all of you a great conference, and I will hopefully see you in a few minutes during happy hour. I'll now turn this over to Patty for her to finish up.
Terrific. Thank you, Allison, so much. Some really interesting case studies. It's going to keep me on the straight and narrow. I know that for sure. But everyone, please enjoy your break. And be sure to join us for our closing event, a presentation by On the Rocks Premium Cocktails. The link to that is in the agenda. We hope to see you right at 3:50 for that happy hour. Thanks so much.